This is not hype. This is not sensational. This isn't a BRICS new trading currency. This isn't the end of the dollar. No, this is just basic debt math. And sadly, I do not see any way out of it other than an inflationary nightmare because of QE, which devalues the currency and crushes the middle class and devalues the currency in your wallet or your portfolio, or we continue higher for longer and we destroy the market by massive deflation. But the Fed will always pivot towards an inflationary policy. When they have to choose between the Treasury and the currency, they'll let the currency die.
When the U.S. Federal Reserve announced it was embarking on an aggressive interest rate hike campaign to stamp out inflation and bring it down to 2%, many economists and macro analysts questioned the wisdom behind such policy moves. These critics pointed out that the Fed was planning to use the wrong tool to tackle the wrong type of inflation. They explained further that there are two main drivers of money creation: increased bank lending and money printing by central banks to fund government spending. When there is increased bank lending, there will be too much money chasing the same amount or fewer goods, which usually translates to higher prices. An increase in interest rates will discourage further borrowing, reduce the money in circulation, and curb inflation. However, if the culprit is money printing, as is the case now, higher rates will increase debt service costs, leading to a rise in government deficits, more inflationary printing, and more often than not, a stronger wave of inflation. So, rather than solve the problem, using higher interest rates to combat deficit-driven inflation will only provide a temporary fix before an even bigger problem surfaces. According to renowned author and commercial director at Matterhorn Asset Management, Matthew Piepenburg, the decline of the U.S. dollar is now a mathematical certainty, as the Fed has no choice but to keep inflating to save the Treasury Department while we draw rapidly closer to the dollar's demise. During a recent interview with Liberty and Finance, Piepenburg explains that the reckless monetary policies of the past decade, especially the past 3 years, have led us to the path of fiscal dominance, an economic condition that occurs when a country's debt and deficit levels are sufficiently high. So high that monetary policy ceases to be an effective tool for controlling inflation. He explains that the recent bout of inflation is deficit-driven, attributable to the fiscal stimulus announced during the pandemic. By raising rates to combat it, the Fed is using the 1970s playbook to fight a 1940s problem. Piepenburg says this is a reckless policy that has set in motion a string of events that will lead to the eventual downfall of the dollar. We will now bring you clips from this video, but before we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Also, ensure you drop your comments and observations in the comments section below. Thanks, and enjoy the video.
It's called fiscal dominance is the concept, and it's absolutely at the point where the vaccine no longer fights the virus, to use a bad metaphor in the last few years. But what we've done by expanding debt, raising the cost of that debt through a rising rate environment to quote unquote fight inflation, that has only a short-term effect. The long-term effect is, as those rates go higher and as the debt expands exponentially, then the cost of that debt becomes unsustainable, not just theoretically, but in real time. And that's where you hit this wall of fiscal dominance, where you're doomed if you do, you're doomed if you don't. As you raise rates, the interest expense on Uncle Sam's IOUs goes past the $1 trillion mark. And you have to print money or manufacture synthetic money to cover that debt expense. And that is a disaster because that's inherently inflationary. So again, this is not a fringe concept. It's basic math and basic history. There's 7.5 trillion U.S. treasuries held by foreigners, and people like Brent Johnson, who I respect, or others who have this milkshake theory concept say, well, look, it's true, and even Brent Johnson would agree, and other strong dollar proponents would agree that our debt situation is ultimately fatal and ultimately destructive. But at some point when things go really bad globally or even nationally, but certainly globally, that there is no other place to go but the U.S. dollar. There will be a flow into the U.S. dollar, and that will be good for the U.S. dollar. What I'm arguing and I'm saying is a number of things suggest that flow has already occurred, and that flow isn't going to come and bail out the U.S. dollar. As rates go up, the dollar will get stronger. But eventually, as rates become too high, that U.S. Treasury bond becomes too expensive. And so we have to print more money to sustain our bond market, which is ultimately inflationary. So inflation and deflation are not a zero-sum game. They're cyclical. We can clearly see deflationary forces right now, but to declare victory right now is an absolute mistake. And eventually we're going to hit such a high debt wall and such a high interest expense that liquidity from the Fed and liquidity from the Treasury and liquidity into the repo markets is no longer theoretical. It's inevitable. What we're doing with our U.S. Treasury market, what we're doing with our bond market, is we have printed for years to postpone the inevitable, which is the inevitable destruction of the U.S. Treasury and the destruction of the U.S. dollar. And that will be inevitably because there is no other buyers of our IOUs but our own piggy bank. And our own piggy bank is the Federal Reserve. And the Federal Reserve makes money by mouse clicking zeros, not by productivity, not by tax receipts. This is no longer, I need to stress, this is no longer just a bearish theory. It's basic math. Year over year tax receipts are down 20%. GDP is climbing, but it's only be climbing because our deficits are climbing. So they're calling that debt-based growth. But to me, that's an oxymoron. I call it the oxymoron of morons, because debt-based growth is not growth. It's just maxing out credit cards. You can look fine. You can buy nice clothes and nice car and nice dinners with a credit card. But if you don't have the money to pay for it, that's not growth. That's buying time. And we've just, in this last year alone, we've raised the debt ceiling, basically got rid of the debt ceiling. We're now looking at $1.9 trillion in additional spending on the back end of this year, additional borrowing from the Treasury Department. We're running out of money to pay for that other than through a mouse clicker. And in September of 2022, Yellen was able to basically spend from the Treasury General account, take money out of that. That's empty. We're going to need to create more money somehow. It's not coming from foreign borrowers. They've been dumping treasuries at record levels last year and this year. They're stacking gold. Tax receipts aren't going to do it. 5.9% Fed now GDP is not going to do it. At some point, you have to sustain that bond market. The Fed will never let a Treasury auction fail. They won't default on their debt. The only buyers of that debt are going to be our piggy bank. Our piggy bank is a mouse clicker. It's a money printer at the Eccles building. That is inflationary. So we will see deflationary moments when you cut demand by crippling the middle class in a high rate environment, killing banks, killing corporations, killing growth at the real level. But the net result is we have to sustain those bonds, and we'll do that by killing the currency. It's a win. It's a lose-lose.
According to experts, government debt exceeding 100% of GDP appears to be the point at which the efficacy of monetary policy degrades and fiscal policy begins to dominate inflationary outcomes. U.S. government debt accounted for 122.8% of the country's nominal GDP as of June 2023 and is projected to hit 133% of GDP by the end of 2023. There is no way politicians, both Democrats and Republicans, will approve cuts to entitlement spending, and tax revenues have been taking hits after hits for months. This means the only solution is for the Federal Reserve to keep inflating and somehow hope that we can continue to kick the can down the road without repercussions. However, Piepenburg says those repercussions are going to catch up with the dollar much sooner than we expect. Apparently, so does the Congressional Budget Office, which recently released this chart showing the projections for the U.S. federal debt. Let's get back to the interview as Piepenburg further discusses the problem and what this means for the U.S. dollar and U.S. investors.
Because the Fed has three choices, Elijah. They can do nothing, continue to raise rates, which will cripple the bond market, kill even more banks. And believe me, what I'm hearing from the banks is there's more about this struggle. It will cripple the bond market, cripple the Main Street economy, cripple the banking system, and ultimately cripple the stock market, because the stock market lives off low rates. Rising rates kill the stock market too. So staying higher for longer is not a long-term solution. The other solution is you can try and cut our debt levels by a 40% reduction in entitlements or the military, but politicians are not leaders. They're looking for popularity. They will not cut entitlements or military by 40%. So you're not going to get it by staying higher for longer, mathematically. You're not going to get it politically by cutting expenditures or tightening our belt. So the only other option left is synthetic money. That is instant liquidity. We bought some time with the TGA account. Yellen has been fighting Powell in the Treasury to create liquidity. We bailed out some banks to create liquidity. We had the BTFP program and the FDIC extension. We've been borrowing time and creating false liquidity, like Robert E. Lee was borrowing time, winning battles but losing the war. And at this point, we're running into a point where there's no place else to get this money. And sadly, that's going to be an inflationary response to a deflationary policy, where Powell was going to lose either way. Whether he goes higher for longer or whether he pivots, it still destroys our economy through the invisible tax of inflation or by destroying the bond market. And since the bond market can't die, the currency will. And that, of course, is where gold and precious metals just has to bide its time. I'm saying Powell's going to lose this war. I have absolutely no doubt of that. I don't know when it's going to be, if it's the end of this year or the beginning of next year. We are hitting fiscal dominance where our debt is simply too large. There's no other natural buyers of it. We will have to create money with a mouse clicker at the Eccles building to monetize our debt. It's going to be QE writ large. We always see the Fed, it always buckles when there's a crisis. There was a repo crisis in 2019. They created synthetic liquidity. In 2018, Fed tried to raise rates and cut the balance sheet, ended up in unlimited QE by 2019, 2020. Obviously the COVID crash in 2020, we had to respond with trillions of printed dollars. Banking crisis in 2023 was a bigger crisis mathematically than 2008. Instant liquidity. When the markets crash, when the bond markets really struggle, when yields spike too high, the Fed will come up with a reason to have to create more money. The Treasury will come up with different ways. But our fiscal policy and our monetary policy are now at complete odds. I do not see any solution. I think Luke Groman gave a nice story the other day. He said, well, look, there's two miracle solutions, because every baby boomer in the country could die and $65 trillion worth of inherited wealth could suddenly transfer and liquefy America. That's not probably going to happen. Or we come up with some instant battery that doesn't require oil or some new miracle energy solution. But between rising oil prices, rising yields, rising debt, and rising debt costs, and rising inflation from oil prices gone 20% off its bottoms, we have rising inflation, rising debt, and rising debt expenses that we simply cannot afford to pay. And so I don't even think it's worth debating anymore, unless you believe that there'll be some multi-trillion-dollar flow into U.S. treasuries. I'm saying that this time the world's lost faith in that weaponized treasury and that discredited treasury. When we had the first downgrade of the U.S. Treasury many years ago, there was actually a resurgence in buying of U.S. Treasuries. Recently, when the Fitch downgraded our Treasury and our rating score, there was a dumping of Treasuries. We really have reached that fiscal dominance. We've reached that point where no one trusts our U.S. Treasury and hence our U.S. dollar at the same way they did 20, 30 years ago.
According to the renowned author, investing in precious metals is one of the few ways investors can hedge against what he describes as the eventual decline of the dollar. He also talks about the increasing de-dollarization efforts of the BRICS alliance, explaining that outside all the sensationalism about a gold-backed currency, the bloc still poses a lot of threat to the dominance of the United States. He adds that many countries are showing interest because they are looking for a way to transact outside of a debt system, outside of the weaponized dollar and overstretched U.S. Treasury. In addition to weaponizing the dollar against a major economic power and a nuclear power, the U.S. has also been able to alienate Saudi Arabia, the linchpin of the petrodollar system. Piepenburg also reacts to critics who have pointed out that the alliance will not be able to achieve its aim because of the deep cultural and socio-economic divides between members. Piepenburg explains that the BRICS nations don't have to trust one another. They only have to trust gold. He says that's why they have been stacking gold and moving away from U.S. treasuries, which he has explained will be affected regardless of the Fed's next move. Piepenburg believes the Fed has dealt the final blow to the U.S. dollar. Whatever fight they put up now will only be to save face and maybe delay the inevitable some more. Do you agree with this outlook and the role of precious metals as a hedge against the collapse? Please drop your comments in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.